Hello and welcome to Yadnya Investment Academy. Today we are going to know more about frequently used term in economic discussions, that is SLR. Statutory Liquidity Ratio, that is SLR, is the term for mandatory reserve requirement that commercial banks in India require to maintain in form of cash, gold, government approved securities before providing credit or loan to the customers. SLR is determined by RBI in order to control expansion of bank credit. So the repo rate is the rate at which banks borrow short-term money from RBI, and CRR is the percentage of deposits banks have to hold as cash reserves with the RBI, and SLR is that portions of deposits banks have to hold with themselves in highly liquid government securities and other assets which RBI has mandated. So why these reserve requirements are there? Majorly to ensure that banks always have enough liquidity to honor depositors' demands and that they don't lend away all their funds. So banks have to keep 4% of their total deposits as CRR with the RBI, and as SLR another 20% for their total deposits in government securities. So total 24%. These reserves are also used by RBI to tighten or ease monetary conditions in the economy. For instance, 50 basis points, that is 0.5% reduction in SLR in June 2017 leaves more money with banks to lend. So if in the future RBI wants to reduce money supply, it can raise SLR, thus leaving banks with lesser funds to lend. Here is how SLR has moved in last few years. SLR is determined by a percentage of total demand and time liabilities of bank. Time liabilities refer to liabilities which the commercial banks are liable to pay to the customers after a certain period mutually agreed upon, and demand liabilities are such deposits of the customers which are payable on demand at any time. An example of liability is a 6-month fixed deposit which is not payable on demand but only after 6 months. An example of demand liability is a deposit maintained in savings account or current account that is payable on demand through a withdrawal form such as check at any time. Here are details of demand and time liabilities. Few other important info to note about SLR is that maximum limit of SLR is 40% and minimum is 0. In India, RBI always determines the percentage of SLR in their quarterly review. Currently, most banks keep an SLR higher than required due to lack of credible lending options. Near-term reductions are unlikely to increase liquidity and are more symbolic in nature. One of the other benefit of SLR is that it compels the commercial banks to invest in government securities and make sure constant demand of these securities in the market, which makes easier for government to raise the money. If any Indian bank fails to maintain the required level of statutory liquidity ratio, then it becomes liable to pay penalty to RBI. Defaulter bank pays interest at the rate of 3% per annum above the bank rate on the shortfall amount of that particular day. But if the defaulter bank continues to default on the next working day, then the rate of interest can be increased to 5% per annum above bank rate. Bank rate is one more rate notified by RBI in their quarterly review. Main purpose of this bank rate is majorly to determine penalty. That is all we have on this topic of SLR. If you have any question on SLR, please do write in the comment section below and do not forget to subscribe to our channel for more such videos. Have a great time ahead. Jai Hind.